I want to talk about Bloomberg Intelligence, which is Bloomberg's investment research arm. We have 300 research professionals covering 140 industries globally, and we basically track and follow 2,000 companies. For the last 2 years, we have worked closely with Business Week to spearhead a 50 companies to watch program that really takes, of the 2,000 companies we cover, what companies do we think are going to be the most interesting companies in 2019, the year ahead. Looking at one of the things that comes out of these discussions as our analysts talk is what themes, really macro global themes, come out of some of these discussions. And it's things like that affect these 5 companies that I'm going to talk about today, which is 5 of the 50. Some of the critical themes that came out are things like internet disruption, Internet of Things, real estate also tied to the internet and what that has to do with overcapacity. Obviously, emerging markets, transition of energy from old energy sources to new energy sources, and really looking at which of these companies are dominant players in their respective industries. In addition to talking about these 5 companies, I'm also going to make some mention of 5G, which is one of the most important sort of super themes that we've come up with as a department that we think we're going to be talking about for the next decade. Let's go into the companies and talk about them, starting with Indigo. Rahul Kapoor is our Singapore-based transportation analyst, covers Indigo, and really talks about this being a dominant player in an emerging market. The first point that he would make is that India is a huge market, a market that's going to surpass China in terms of population in the next several years. We look at total airline traffic growth growing 20% or more a year. And what's interesting about this particular company is just how dominant it is. If you take a look at the top slide, 43% of that market, more than 3 times the size of the next largest competitor. And I'd point out that they have very limited debt versus many of their competitors, which are really having various struggles. I'd also point out the second chart shows just how low cost structure they are. That's for a variety of reasons, but in particular, it's important that they focus on the Airbus 320, much like over the last several decades, Southwest Airlines in the US made such a huge success focusing on the 737. What are the catalysts that are going to drive this company? The catalysts that are going to drive this company really twofold. One is costs. They do not hedge oil for a variety of reasons. Oil was a problem in the middle part of this year, but for the last couple of months, obviously with the big drop in oil, that will be a big help. In addition, capacity, they will expand capacity 25 to 30%, further solidifying their absolute dominance in this market. At 16 times forward earnings, it's a 25% discount to the overall India broader market. Moving on to retail real estate, Sue Munden, our London-based real estate analyst, looks at Hammerson, and she talks about this as a retail real estate company that will survive the debacle of the internet over the past several years. Looking at this company and the business drivers, it is a competitor that is unique in terms of a proprietary focus on retail in the real estate market. It's got a high-end focus on flagship malls in major cities that are still growing. The catalyst for this company that she talks about is the internet. Obviously, it's been a big problem for retailers, but going forward, Sue thinks that the internet is going to be a lessening impact really from a differentiation perspective. It's going to start identifying those with good assets in the retail market and those with bad assets in the retail market. And that will differentiate companies like a Hammerson in the UK. I would also point out that Hammerson is starting to divest many of its assets that are the lower performing retail parks. And the top graph here shows the pink line is how much weaker the retail parks have been doing versus their flagship malls. That's really where they're going to be focusing on in the future. That capital coming out of this company will be used to grow, to basically pay down debt and to buy back shares. The stock is interesting in the sense from a valuation perspective that the net asset value has increased consistently over the years, and yet the stock has kept dropping while it's performing better and better. So 50% discount to net asset value with a 6% dividend yield. Moving on to Japan, fast retailing, a company people in Japan would know as Uniqlo, has been a very successful retail growth story in the fast fashion industry. Tom Jastrab, our consumer and retail analyst in Hong Kong, really thinks this is an interesting growth story. Fast fashion are companies like Zara or H&M. This is the third largest of that type, but they have a unique twist on their fast fashion, which is more performance athletic oriented, which really differentiates them. But regardless, they are still a supply chain automation company that allows them to bring in very low price points, very high quality products with very fast product cycle turns, much faster than its competitors. And that's how these companies have really differentiated themselves. What's interesting about the catalyst on this company is it's really starting to grow internationally. As you can look at the top of the market, Japan is a portion of its business, less than 50%. But this year, operating profits from non-Japanese stores will be more than 50% for the first time. And as you can see in the lower chart, the company is showing very, very strong international, non-Japanese growth in its operating profits and sales. It's one of the more expensive companies that we highlighted, 33 times earnings, but given the strong double-digit growth for the next several years, we think it's interesting. Going to Cheniere and the U.S. LNG markets, Mark Rosano, one of our oil analysts, has looked at LNG extensively this year and really talks about the opportunity of Cheniere dominating this market. And of course, we all know LNG has an enormous number of tailwinds. Environmental policy is really helping the demand for LNG. One of our partners, BNEF, another research operation in Bloomberg, focuses on these types of products and clean energy. Things like the UN IMO 2020 fuel shipment standards really favor the use of LNG in fuel shipments. Things like that provide many, many different tailwinds. What I think is going to be interesting here is, and I point out that Cheniere is really differentiating. This lower chart, it shows how much lower cost Cheniere's operations are than many other LNG plants throughout the world. What I think is going to be interesting is the new capacity coming on it in 2019 will really drive cash flow for Cheniere. We're looking at early activations of 3 trains, what are known as the lines, that will drive significant free cash flow over the next several years. And actually, their free cash flow will be, for the first time, positive in 2019, which will allow them to pay down debt and ultimately potentially pay a dividend. NXP, Anand Srinivasan, who's our technology analyst, and Rob Schiffman's a senior credit technology analyst, really think this is an interesting company from the perspective of it being in the sweet spot of the semiconductor industry, which is really automotive and industrial. As you can see, that's the majority of their business. This is a large, large company, and more than half their business is in markets that are growing over 10%, which is really, really interesting. Not only is this an interesting company in terms of its mix of business, margin opportunity, consistent sales growth, but they are starting to buy back stock, significantly buy back stock. And what was interesting, Rob Schiffman talked about, is Moody's just upgraded the company to investment grade just recently, in spite of a $5 billion share buyback program. And we think there's a lot more share buyback opportunity, maybe as much as 10% to come after this one. Lastly, I want to talk about 5G, and I want to end with this discussion. This is what we sort of talk about as one of the super themes that we're looking at and will be looking at for the next several years. 5G, look at some of the statistics, 10 to 100 times faster downloads, 5 to 10 times better or lower latency rates. That's the back and forth communication between you and your service provider. Using the spectrum 3 times more efficiently, and more than 300 times as many connections operating on a single cell at a single time. This has huge, huge ramifications for how competitive dynamics play out across all of the 300 analysts that we have covering 2,000 companies. Importantly to note, it's not going to happen right away. Verizon and AT&T will be launching in deployments of 5G this next year for the first time. That will be followed by Japan, South Korea, and China. Everybody, all the countries will be competing to see who can dominate 5G the soonest. But it will be a very competitive operation. In 2022, we expect the U.S. will only be 20% 5G enabled. So it's going to take some time. But that means we're going to have 10 years worth of really, really strong opportunities in 5G deployment. Obviously, who benefits? The carriers, the handset manufacturers, the tower companies, the equipment manufacturers. Those are all obvious. We understand that. But really, this is something that's going to affect the worldwide economy. It's going to change the way people do business. And my guess is that over the next several years, as we have conferences, year-ahead conferences, this will be a big part of what shapes our future ideas. Thank you.